Hare Krishna. Welcome to Tax YouTube channel. This is CA Rohanar Pingale, practicing chartered accountant based in Mumbai, also partner in Motilal and Associates LLP, member firm of Marks Network. And today we are going to conduct a special video on taxation of cooperative societies under Income Tax Act 2025. So let's dive into it. Let me allow to share my screen. Yes. So, cooperative societies have always enjoyed what a unique and a favorable tax treatment under Indian income tax law because they are the mutual benefit organization and play vital role in the rural and agriculture economy such as dairy, sugar, credit, and housing societies. So, New Income Tax Act 2025 has not disturbed this core philosophy at all. It has simply renumbered the provisions and used what much cleaner language and moved many details into what schedules for easier reference. For example, the popular deduction that was earlier available under old section 80P of the Income Tax Act 1961 is now available under section 149 of the Income Tax Act 2025, supported by an interpretation section 150. So in this video, in this segment, we will cover the base taxation and slab rates, the important deduction under section 149, special concessional regimes, that is old section 115 BAD and 115 BAE, now under section 203 and 204, and the alternate minimum tax, yes, AMT, which continues with some rationalization. This topic is highly relevant because what many of you handle the dairy, sugar, credit, or multi-state cooperative societies in your practice. So we will focus on practical aspects so that you can apply the knowledge immediately. So moving further, let's understand why special treatment for cooperative societies. So cooperative societies are fundamentally what different from regular companies or firms because they work on the principle of what mutual benefit rather than a pure profit motive. So their primary objective is to serve their members. What primary objective is serve to their members, whether it is providing cheap credit, marketing agricultural produce, or supplying milk and seeds. So this is why the law has always given them a special treatment. The deduction earlier available under old section 80P is now continued under section 149 for specified activities. Unlike companies that pay flat 25% or 30%, cooperative societies enjoy what? Separate slab rates like 10% up to 10,000, 20% on the next 10,000 and 30% thereafter, plus surcharge and sales. So the concessional optional regimes introduced in 2020 and 2023 have also been fully preserved, no change. In practice, the special treatment encourages what collective economic activity in rural areas. So, uh, so this segment will be particularly useful for all those who are in dairy, sugar, or credit societies. Okay. So let's move further, understand base tax rates for cooperative societies. So the base slab rates for cooperative societies have seen what no major change at all. They continued as it is to be, that is 10%, 20%, okay, and 30%. So surcharge rates have been also rationalized in some income brackets. That is, for example, 7% in the rupees 1 crore to 10 crore range in certain cases, and health and education says remains at 4%. So the new act has presented these rates more clearly in the first schedule using what tables, which reduces the scope for the disputes. Marginal relief provisions also continued, no change. In practice, when computing tax liability for societies, always carefully consider the what surcharge thresholds because even a small difference in income can push the effective rate higher. So advise your cooperative clients to compute their liability well in advance, especially when they have surplus from members' activities. Moving further, let's understand deduction under section 149. Corresponding section 880P of Old Income Tax Act 1961. So this is the heart of the cooperative taxation. Okay, the deduction earlier available under old section 80P is now under 149. So let me explain with the practical examples. A credit cooperative society earns interest from loans given exclusively to its members. This income is fully deductible under section 149. Similarly, a marketing society that sells what agricultural produce grown by its members also gets the deduction. So, go down letting for storage commodities, supply of milk, oil seeds, and certain primary society activities are also covered. So, recent budget, that is 2026, extensions have included supply of what cattle feed and cotton seeds from primary societies. So these are now included. So new act has also clarified that inter cooperative dividend, very important, inter cooperative dividend is also deductible if it is further distributed to who? Members. So this is a welcome clarification for federations and apex society. So judicial precedents on the distinction between the members and non-members continue to apply in current Income Tax Act also. In practice, always maintain clear segregation of member and non-member income to support what you are claimed during the assessment. Moving further, let's understand key eligible activities under section 149. So section 149 lists specific eligible activities for which deduction is available. So main ones are including what providing banking or credit facilities exclusively to members, running a cottage industries, marketing agricultural produce grown by the members, supplying seeds and implements to the members, processing agricultural produce and letting of godowns. So many societies claim what 100% deduction when their activities are restricted to the members. However, any income from non-members or from investments may not qualify for the deduction. So in practice, it is advisable to maintain what separate books or proper allocation between the member and non-member income. So new act has used modern language and increased what some monetary limits in certain sub-clauses. For example, a dairy society procuring milk from the members and selling it after processing can claim deduction on the profit from the member-related activities only. But profit from sales to outsiders may be taxable. Let's see limitations and conditions for ATP and now current section 149 deduction. So it is important to understand the limitations. Though deduction under section 149 is available, yes, only on but what income from the specified activities. If a society is engaged in activities not listed therein in the section, no deduction is available on that income. So for consumer cooperative societies, the deduction is limited to certain 1 minute. So if a society is engaged in activities not listed in the section, no deduction is available on what their on that particular income. So for consumer cooperative societies, the deduction is limited to certain amounts. Housing societies are generally not eligible for the full deduction on maintenance charges or other income. So new act has extended the definition here of cooperative society to explicitly include societies registered under the Multi-State Cooperative Societies Act 2002. That is main amendment in the new act. So in practice, always verify the object clause in the bylaws and the actual activities being carried out by the society. So many dispute arises when societies claim deduction on an income that is not directly linked to the eligible activity. So what is important here is that the new act has extended to where the explicitly include the societies registered under the Multi-State Cooperative Societies Act 2002. Now they are also covered. Moving further, let's see special concessional regime under section 203, old section 115 BAT. So apart from the regular deduction under section 149, cooperative societies also have an option to go or avail concessional regime under section 203. So this regime allows what tax at the rate of 22%, like we can have in companies. So plus surcharge and sales will be effective rate will be 25.17%. So this option is popular among the societies that have high taxable income even after the claiming section 149 deduction. However, they have to forego what most of the deductions and cannot set off the certain losses. So option one's exercise also become irrevocable. It must be applied from prescribed from to avail that option. But also it is what keep in mind that it is generally irrevocable. It's once you obtain, you cannot go back. So in practice, many societies offer this regime to reduce their effective tax rates and simplify the compliance. But before recommending it to your client, it is always better to compare the tax liability under normal provisions versus 22% regime, and that is also projection for at least 5 to 7 years. So societies prefer to stay with section 149 if their member related income fully qualifies for the deduction. Next, let's understand special regime for new manufacturing cooperative societies. Same as company, here it is section 204, old section 115 BAE. So here this is the make in cooperative incentive, similar to the 15% regime for the companies. Okay. Under section 204, earlier old section 115 BA, eligible cooperative societies engaged in what? Manufacturing or a production of articles or generation of electricity can pay tax at the rate of only 15% on their business income. So the conditions are strict. Society must be set up after the specified date and should not be formed by splitting or reconstruction of an existing business. It must be new. So limited deductions are still allowed. Many dairy processing or sugar manufacturing societies can benefit if they expand their manufacturing activities. So in practice, proper documentation of the new investment, commencement date, and separate books is essential because while in assessment, assessing officer closely examine all these whether the new activity is genuinely independent or not. So compare this 15% regime with 22% also with a normal provision also, and then advise to your client by making at least 4 to 5 years projection before, because it is a irrevocable option. Moving further, let's understand conditions common to both special regimes. So both the 22% regime under section 203 and 15% regime under section 204 have several common conditions. Societies have to forego what most of the exemptions and incentives to avail these options. So once opted, they are exempt from AMT. That is very much important. You are not liable to pay AMT, alternate minimum tax, when you go to these options. So depreciation is all allowed as per the prescribed rules with a possible written down value adjustment. So this option must be exercised through the prescribed form. In practice, when a society opts for these concessional regimes, it generally has to forego what benefits of section 149 deduction. So always prepare a 3 scenario comparison for the managing committee for normal taxation, 22% regime and 15% regime. So they can take an informed decision. Let's moving further. Alternate minimum tax for cooperative societies. Very important aspect. So cooperative societies that do not opt for the concessional regimes, okay, are continued in old regime are subject to what? Alternate minimum tax at a concessional rate of 15% of adjusted total income. So this is lower than 18.5% rate applicable to the other assessee. So AMT is triggered when the normal tax liability is lower than 15% of the adjusted total income. So your adjusted total income is calculated by adding back certain deductions to the total income, excluding the section 149 deduction in some computation. So if AMT is higher, the society has to pay what? AMT and can claim credit for the difference. So which can be carried forward how many years? 15 years, right? So new section 206 has organized these computations better with tables. Concessional regime societies are fully exempt from AMT. In practice, societies claiming large section 149 deductions should compute AMT every year to avoid surprises during their assessments. Let's see AMT computation step by step. Compute total income as per normal provisions, add back eligible deductions, arrive at adjusted total income, then your AMT equal to 15% of adjusted total income plus surcharge plus cess, pay higher of normal tax or AMT, and your credit is will be AMT paid minus normal tax, carry forward to 15 years. So let's talk about AMT credit now, old versus new treatment. Very important to understand. AMT credit treatment is similar to MAT credit for companies. The credit can be carried forward for 15 years and set off in years when normal tax liability exceeds. So new act fully protects the all accumulated credit up to the transition period. But please have a look here. Whatever credit of AMT accumulated as on 31st March 2026, you can utilize it in the year 26-27 if you are continued with old regime. Very important. When you will use that credit, when you are continued with the old regime, and you can set off fully. Here, 25% cap like companies is not there. But when you shift to the new regime, okay, in 26-27 or thereafter, then you cannot use your empty credit. If it is remain there, it will be lapsed completely. So that is why before advising your client, you need to project it, and you have to streamline how to use this AMT credit, means how many years you have to continue with the old regime. Because what in companies cases, in MAT case, credit accumulated as on 31st March 2026 can be utilized only when they shift to the new regime, and that is also to the extent of 25%. If they continued with a uh, old regime, then they cannot claim the MAT credit. That is the main difference between this. When in case of AMT, when you continued with old regime, then you can claim the set off of AMT credit as on accumulated as on 31st March 2026. But you shift to the new regime, then you cannot. So you have to continue with the old regime. And that is also there is a no 25% cap in case of AMT credit to be set off for under cooperative societies. So this is the very important change. So let's understand return filings on compliance for the cooperative society. So here also cooperative societies generally file their return in ITR 5. So audit is required if turnover exceeds the prescribed threshold. This limits remains unchanged. There is no change. Due date for audited cases continues to be 31st October. Okay. So in the new act, all return provisions are unified under section 263, earlier section 139, now under Income Tax Act 2025, return filing section is section 263. So you need to report AMT liability, if any, in the return. Update your software with the new section references like 149 instead of 80p. So in the transition year, be careful while reconciling old and new numbering. So, but however, for financial year 25-26, we are going to file ITR 5 and there is no changes. Means there will be no use of new sections in particular while we are filing the financial year 25-26 in assessment year 26-27. So that is very important to understand. Let's see practical checklist for cooperative society. So first, verify that the activities actually qualify under section 149. Very important. Second, maintain clear segregation of income from the members and non-members, because only member-related income qualifies for what? Deductions. So third, compute AMT whenever the society claims heavy deductions under section 149. Always evaluate three options: normal taxation with section 149 deduction, 22% regime and 15% regime, and present a comparison to the managing committee of your client. So finally, update the bylaws, board resolutions and all compliance documents with the new section references wherever necessary. Following the checklist annually will reduce toward notices and help societies optimize their tax position. So let's see key changes, old versus new Income Tax Act 2025. So let's summarize whatever we have studied till now. So key changes for cooperative society is old section 80p to now section 149. So additional interpretation section 150 that makes the new law much clearer. So concessional regimes are now under section what? 203 and 204 with identical conditions, same conditions. AMT continues under section 206 at the same rate, 15% rate for cooperative. So new act has extended what and clarified the deductions for inter-cooperative dividends. That is important in certain cases. If you have distributed to the members, then eligible for deduction. So overall, the language is simplified. Many details are moved to the schedules and in table format, and there is no major change in rates or benefits. So substantive provisions are preserved, making compliance easier while reducing the scope for the disputes. So let's take a few case studies. So let's first case, a dairy cooperative society procures what milk from its members, processes it, and sells the products. The profit from procurement and supply to the members qualifies for full deduction under section 149. But profit from sales to non-members or investment income may be what? Taxable. So proper segregation of income is essential. Second case, a sugar society has substantial profit even after section 149 deduction. So should it continue with the normal taxation or shift to the 22% regime under section 203 is the question. So 22% regime gives simplicity but requires what? Foregoing all the section 149 benefits. So that's need to be taken care of while deciding what to do, whether shift to the new regime or continue with the old regime. And also you accumulated AMT credit that need to be seen. So next, third case, a society with a high investment income claims what last section 149 deduction on members' activities. It may be liable to AMT if the adjusted total income is high. So compute AMT every year. Don't ignore it. Next case, a society has accumulated AMT credit, planned whether and when to shift to the concessional regime to utilize your credit option optimally. So this real time scenarios will help us to guide our clients effectively. Moving further, let's understand common pitfalls and best practices. So some of the common pitfalls to avoid are many societies claim deduction under section 149 on income that is not directly linked to their eligible activities, leading to what disallowance during the assessment. So some societies forget to compute also AMT when their normal tax is low due to heavy deductions. So once a society opts for 22% or 15% regime, it cannot easily go back. That is, the option is irrevocable. So that must be kept in mind. Poor documentation of the members versus non-member activities is a frequent cause of dispute. So finally, after 1st April 2026, always use the new section references in all your filings of new forms or whatever you are doing that is related to 26-27 tax year. So best practice is to conduct an annual health check covering section 149 eligibility and AMT computation and regime evaluation. So proper documentation and timely advice can save what societies from unnecessary tax demands and penalties. So key takeaways from the cooperative societies taxations now to summarize this particular session will be section 149 continues to be a powerful tax incentive for genuine member related activities of the cooperative societies. The optimal concessional regimes under section 203, 204 provide what alternative for simplification and lower effective tax rate also. MT at 15% act as a safety net to prevent the zero taxation through excessive deductions. New Act has brought what greater clarity through simpler language and schedule and tables without changing the basic policy that is philosophy behind the logic. In practice, always advise your cooperative clients to evaluate what the best regime with a 3 to 5 year projection. Focus on proper documentation and annual review. This will what reduce your compliance burden and help societies grow sustainability. So that's it for today. Thank you. Thank you so much for patient hearing. If you have any questions, observations, suggestions, then do let me know via WhatsApp, email, or you can also comment below the video. If you are not yet subscribed to Tax YouTube channel, then do subscribe for latest updates and video series like this, which we are conducting on our Tax YouTube channel. Thank you so much once again. Bye bye. Take care. See you soon. Hare Krishna.